This is the Trading Psychology Podcast, and this is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, is a very well-traveled Robb Reinhold.
Hello, everybody. Nice to be here. Just a little background about myself. I started trading in 1997, and I've been doing this for a long time, and I got to tell you, once you've been doing this for a very long time, it's really nice because you understand all of the ups and downs. They've happened thousands of times in your life, and I wish I could impart that onto you. You just have to keep going to where you get to a point where you understand these markets just move up and down. Nice to be here with you and share my experiences with you.
Likewise, Rob. And for episode 18, a little bit of a different format today, but some housekeeping first that I think is necessary for the channel. First off, like I said before, we're still having issues with people being able to comment on the videos. If you're watching this on YouTube, it's still a problem. Like, we got Dan Stone back able again, and we don't know if we have Rob back just yet. He's going to try probably this episode to make some comments and responses. On episode 17, we had some really great long-form comments, very daring comments that just didn't make it onto the comment section. I saw them and I approved them, but they just didn't make it on there yet. So if this is happening to you, don't feel bad. It is a YouTube thing. They aren't getting back to me fast, which is not uncommon. But understand we are aware of it, and we do appreciate the comments. It just might not show up on the final page. On that note, on the very first book giveaway, we had issues with that too, and some people aren't getting their books. So what I did for the pinned comment last week, a reminder, all the people who won the Maverick trading book, you are on the pinned comment. What you need to do is email support@mavericktrading.com and claim your book, and Rob will send it right over to you. Also, Apple Podcasts. I am going back and forth with them still, ever since like episode 5. Trying to get on Apple Podcasts, it is never easy. So give us some time on there. We do plan on being there. And with Apple, you get all the other podcast players like Player FM, Overcast, all that kind of stuff too. So we're almost there, and I will certainly announce when we are. Now, Rob, did you have anything to add as far as the comments in the book and all that goes before we get started?
I just wanted to add that I've actually heard from 4 out of the 5 winners of our first book giveaway on Peak, and most of them already have their book.
The format's going to be a little bit different. I'm going to take the first half. Rob's going to take the majority of the second half, and we have some differing ideas here, but that's okay, because there's a certain place in time where this is going to even apply, and by then you can go a couple different directions. I have my way. Maverick Trading has theirs. And there's not always going to be some crossover. So understand, you might hear some things in this episode that would deviate a little bit from the no-nonsense Forex system of trading. But then again, you have options. You can take all of this any direction you want. That's always been the case. So the question at hand is when to risk more money. I have always said that trading with real money, regardless of what direction you plan on going in the future, is essential, because you need to know how it feels to have actual money on the line. But there is probably going to come a point in time where you're trading, the amount of money you're trading just isn't going to be meaningful anymore, and you may need to risk more. Or you are actually trying to do this for a living off of your trading account, and the profits you're making, albeit good profits, aren't enough to live off of, or just aren't very exciting. So there's going to come a time where this comes into play. The way I want to lead this off is understand, this is not something that is going to apply to anybody who has been trading for probably 3 years or less. Harken back to the video we just made on experience. You're not good enough to add more money for a really long time. I think we established that in that episode. Why are you going to add more money if you're not in a place to where you're making almost no mistakes compared to what you were making before? This is really important. One of the worst things you can do, in my opinion, is to add on money when you're still making dumb mistakes. And in your first few years, you're still going to be making dumb mistakes. That's just how it goes. That's why we do this entire podcast, is to help eliminate those mistakes along the way, but you're still going to make them. That's really, point number one, and the main point I wanted to throw at you. I don't have great answers for exactly how to approach this, but I can definitely tell you the when. And the when is going to be after you have gotten enough experience under your belt to where you're playing jazz and all of this just comes naturally to you and you're not making those dumb mistakes and you've been through enough of those externals, crazy markets, dead markets, wild news events, to where even throughout all of those, you're still not making dumb mistakes. Once you're at that point, now you can start asking other questions. And one of those big questions is, okay, when should I start risking more money? And what is the best way to approach it? And Rob has a series of answers, possible answers for you that he's going to go over now. Rob, go ahead and take it away.
Thanks, Patrick. I'm going to point back to episode 11. In episode 11, we talked about going from demo to live. And Patrick, you are so correct. You need to be live trading for a while because there are so many things that you need to learn. The reason why I actually said to go a little faster from demo to live is because that's the real world of trading. Where you win the game of trading is not really in the charts. It's about managing you and being able to figure out how to win in this game. And without real money on the line, you're just not really learning the world of trading. Once you have been trading live capital, the question is, number one, are you profitable? And that's just where we start. If you are not profitable, there's no reason whatsoever to increase position size. Patrick, do you have anything to add to that? It's pretty straightforward.
No, I think that's obvious. And I think that goes along with the point I made before to where if you are trading a system that you have thoroughly tested properly and you're trading it the right way, you should be profitable at that point. It'd be really hard not to, I think.
All right, now let's get into real hard specifics because we just used the term profitable. What does that even mean? Does that mean for the week, for the month, for the quarter, for the year? Does that mean over your last 5 trades, your last 12 trades? Okay, does everyone see how all of a sudden we have all these buzzwords like, oh, we want to be a profitable trader? You have to quantify what in the hell that actually means. What does it mean to be quote unquote profitable? This is where you really need to be thoughtful about metrics. Remember in our Trade Like an Athlete episode, we talked about everything needs to be recorded, measured, and evaluated. So let's talk about this term profitable. What in the world does profitable mean? You have to set that up. Now look, we might all have different definitions, but what we want you to do is sit down in the beginning and you determine what profitable is to you. You may say, okay, I need 6 months of profitability and I'm okay with having one losing month in those 6. Now look, you are setting your parameters for what is profitable. Someone else might have something different. Obviously, what you want to do is make it long enough and within enough trades, enough sample size for it to be a realistic judge of your skill. That's very general. I'll give you some hard numbers here in a second, but Patrick, do you have anything to add to this? What are the parameters people should use to determine profitable?
It's such a vague term. Yeah, I never really thought about how to define it myself. So if you have a better answer, yeah, take it away.
I don't know if I have a better answer. I just have an answer.
Well, I had no answer, so any answer is better than mine.
Let me just reinforce what I just said. You need to determine what this is, what profitability is, and you need to determine it in advance. No, you don't get to look back on what you did over the last month and determine, well, I just wanted to look at a month. And conveniently, you have a month worth of positive data, and all of a sudden now you're profitable. No, you have to set this in advance. What is profitability? And what does that mean? I know at Maverick, we have some very clear terms of what profitability means. Profitability is simply your account value goes up above what's called a high watermark. If you don't know what a high watermark is, a high watermark, let's say you start with $10,000 of trading capital. The first month you are profitable $500. So now your account's at $10,500. The next month you lose $500. Now you're back down to $10,000. And let's say the next month you make $500 again. Now you could take a look at that and say, oh, that was a profitable month. Not really. You just simply recovered the money you lost in the past month. You actually have to go above 10,500 to be considered profitable because that was your high water mark. So that is the benchmark we set at Maverick is we want to see you with 2 profitable months above a high water mark before you get to trade any more money. Now look, that's what we use. You are free to use whatever else you want, but I think that's a very good way to determine profitability. What do you think, Patrick?
I think that's really good, and this is why I defer to you on things like this, because you guys have a structure that you use that's very important to the overall prosperity of your company. I mean, this is big. How do you determine when to give a trader more money, because that's a big decision, and that decision can go south on you right away. Please, give us any kind of structure you can on this, because this is something that I've never had to have on my own channel, but you absolutely have, to the point to where you guys, this affects your bottom line in a big way. So yeah, please take it away on this.
Okay, well, great. If you want to use that, use that. If you want to change it somehow, change it. You want to set up your own definition of profitable. Now, once you've hit that profitable mark, now we need to talk about when to add money. I always like to refer to position sizing and account size as the volume knob of your trading account. When you turn on music, the music is the music. However, the volume knob just makes it louder or quieter. In trading, your trading numbers are your trading numbers. The amount of money you have on the line is simply the volume knob. If you have bad music, if you have bad trading results and you turn up the volume knob, you're going to get worse results. If you have good trading results and you turn up the volume knob, you're going to get better results. But it doesn't change the music. It doesn't change your trading number. As long as you have your trading numbers and you've met that definition of profitability, then all of a sudden we need to talk about turning up the volume knob. This is something that people don't understand. I would have to say that 70 to 80% of the people we get in at Maverick, and probably most of the people that get into trading at all, are generally left-brainers. They have linear thoughts. They have logical thoughts. It's just what personality type gets attracted to trading. So when you have this mindset that it's very linear, very logical, math is math. Math is very, very simple. It simply, you put in the equation and it equals this. If you have good trading numbers, and you add more capital to it, you get more money at the end. What they don't understand is there are psychological traps when you increase your position size. Now, logically, and I know there's a lot of you out there thinking right now, logically, well, Rob, that doesn't make any sense. It's just a zero. Like if you're trading a $1,000 account and then you move up to a $10,000 account, if you're making the same trades with the same 2% of position sizing risk, that should be the same trade. And frankly, it should be the same trade as a $100,000 account and $1 million account and a $10 million account and a $100 million account. The math is the math, and it shouldn't change anything. And so we as logical thinkers, left-brainers, it's just math. It shouldn't affect you in any way, shape, or form. Here's the problem. It does. And I've seen this firsthand. So I want to actually have a discussion with you about what are some of the pitfalls that are going to happen when you do start to trade more capital. First one I see is,
I just want to agree with this. I mean, yeah, our logical brain says, because we're not, right now we're not actually trading it, it's not in front of us, that a zero is just another zero, because it is. That's 100% true. But it is not going to feel that way when it happens. And like I said, I don't have a structure for this myself. You guys have always taken care of this. It's almost like on your end and I just trade it. And I always try to separate myself from it that way. But once I got more money to trade, I remember that first time, everything changed. It should not have changed. It was just another zero, like you said. But it absolutely did. And there's reasons why, and you and I talked before the show about those reasons, so I'll go ahead and hand it back over to you. But everybody listen to this, because I think a lot of these reasons are going to hit hard very personally with some of you who have gone through this already. Believe you me, it does change things, but it shouldn't. So let's get ahead of this now.
Let me share a story just so we can really see how this affects people. Years ago, one of our best traders, he was a great trader, very profitable, was just fantastic. Finally went and bought a really big house. Moved into this really nice neighborhood, really big house. He had no mortgage before, and now he had a $4,000 mortgage. From that moment on, the trading wasn't nearly as good. I talked with him and we discussed things, and he said, Rob, every trade I make, I now see my mortgage payment. I now see that, oh, I can't take this loss. This is half of my mortgage payment. And he wouldn't take his loss because he couldn't lose half a mortgage payment. Do you see how that all of a sudden changes everything in your mind? When you have a small account value and your losses are $50, you're going to recover from that. That's fine. That's not a big deal. But once you start to get losses that are larger than car payments, larger than house payments, once you take losses that are six-figure losses, promise you it changes. Patrick, do you remember the time you got to the point where a loss equaled a car payment?
Absolutely, because I probably went from a loss that equaled a couple candy bars up to a loss that was about half a car payment. So that was probably at the time, like maybe all of my bills for the month, and I would lose it in a day, and that's a lot to wrap your head around sometimes. And I wasn't dealing with that before. My losses were very easy to manage because they didn't mean anything. But now all of a sudden, in my head at least, they did. You guys are lying to yourself if you think this is not going to affect your trading. So this is exactly why we're trying to get ahead of it.
Everything is relative. I've taken losses that were more than houses. Now, just think about that. I remember talking to a good friend of mine, and I'd actually had a bad week. And he asked me, how much did you lose this week? And I told him, he's like, that's more than I make in a year. Just to give you some perspective of just how to handle that. All of a sudden, can you imagine losing a 1 year of of someone's salary? But it's just math. It's just a zero. There should be no difference whatsoever. But the problem is there is. So the reason we are doing this episode is we want to make sure that you are doing this correctly so you aren't jumping too far forward. Because if you jump too far forward, you're not ready for it. You need to go from losing a candy bar to losing what you paid for the latest video game, and then to your electric bill, and then to your car payment, and then to half a mortgage payment or half a rent payment. You have to go through all those steps, because if you don't, you will have more psychological problems because of it. So let's talk about adding capital. Now I'm going to go back to where we started until you are a profitable trader. And again, you are going to write down and quantify what that means. You aren't going to add any money to your account. In episode 11, we talked about the Yerkes-Dodson law. You have to trade enough money for it to be interesting, but not so much money that is stressful. We talked about you should be able to lose that entire account and still be able to sleep at night. As Patrick said, probably the first 3 years, you should not be looking to add any more additional money to your trading account. But once you get to the point where you are, let's talk about how you're going to add new money into it. I'm going to cover a couple scenarios that people will be in. Some of them won't apply to you. Maybe all of them will apply to you. But let's talk about someone who starts out. You've got a decent sized savings account. Let's say you've got $40,000 saved up. But you're definitely not going to start trading with $40,000. You're going to start off with $2,000. And the rest of the money is going to sit wherever it is you want it to sit. Once you get to the point where you are ready to put more money in, you need to develop a plan for when and how much you're going to put in. So again, at Maverick, we have the rule: 2 consistent, profitable months above a high watermark. At that point, you may say, if I can get to this defined point of profitability, I'm now going to take $8,000 of that money and move it into my trading account. And then, if I have another metric of profitability, I'm going to move another $10,000. The worst thing you can do is move it all in there at once. You want to do it in steps, because I promise you, I know you think it's just a zero. The math is the math. It shouldn't matter, but it's going to matter. You need to go from taking $100 losses to $200 losses before you go from a $100 loss to a $1,000 loss. It's wildly different mentally. So build up to it. So if you have personal savings that are sitting there waiting, then this is how you do it. You set up a structure in advance based on metrics that you have provided. Anything you want to add to that, Patrick?
This is the optimal way of doing things, but keep in mind, you might be part of a prop firm that doesn't release their money to you that way. You might go from 2 zeros to 3 zeros to 4 zeros, so you may not get to do things this way. So you have to be ready for any situation that comes your way.
Absolutely. But if you are aware, this whole episode and this whole podcast is just about being self-aware. You are an idiot. I'm an idiot. We're all idiots. We all have these chemicals swirling in our brain, and we think they're conscious thoughts, but they're not. They're chemically induced thoughts from things that happened in our past and things that our DNA says. So to be self-aware that, hey, all of a sudden I have a ton more capital in my account, I need to be very cautious of the psychological problems this might cause. Now just think how different that is than somebody who thinks they are God, who thinks they're great and are in total control of their thoughts. Someone gives them $500,000 and they're ready to trade it all that first day. That person is going to make lots of mistakes because they weren't self-aware enough. So even if you are in that situation, just plan everything out. Be self-aware, plan it out. All right, so let's talk about, again, if you have savings out there, this is how you move it in. Let's also talk about new income. So new income, as you are trading and you're likely, like we talked about in episode 10, building multiple streams of income, you're going to be having periods of time where you have some extra money. How does that go into your account? Same thing. You plan it out. Develop a plan. In the next 3 months, if I am profitable, I'm going to save up $500 each month from my other jobs, my other paycheck, whatever it is. And if I'm profitable by the end of the period, I get to put that money in. If I'm not profitable, I can't put that money in. Do you see how all of a sudden you've got guardrails? Because psychologically, you're going to want to throw it in. Everyone likes more money. Everyone likes to trade more money. You got to do this the right way. What do you think about putting new money in, not from savings, but from income from your work?
I would have really liked to have had that problem. Fortunately, no. Waiting tables is pretty consistently inconsistent and horrible across the board. But I know exactly what you're saying. I think one of the examples we were talking about the other day is if you maybe got an inheritance or something like that, or just a big windfall. You sold a bunch of crypto and now you want to trade with. What do you do now? Because your account just automatically went from something relatively small to maybe quite a bit bigger. I think the best thing you can do is to do what we're talking about on this show. Look, there's going to be about 5, 6, 7 different scenarios out there in terms of more money you're going to be able to trade. Maybe only 1 or 2 are going to apply to you, but the unfortunate fact is you have to be ready for all of them because any of them can happen at any amount of time, and that doesn't excuse you from not being ready. So we're going to do our best here to try to give you a structure. But at the end of the day, you're just going to have to be ready for anything because anything can happen on the good side and on the bad side.
Totally agree. And I want to go back to what we talked about in episode 10, where we talked about multiple streams of income and trading multiple products. At some point, I remember when I finally got my account up above 6 figures and I was very disciplined and I was following all my rules, I realized that there's a lot of cash there doing nothing. Now look, when you have a $5,000 account and you're using, 10, 20% of it, whatever you're using on margin, who really cares about that $2,000 or $3,000 that isn't earning interest or isn't doing anything for you? It's not that big of a deal because the money that will bring you is pennies to dollars. That's it. All of a sudden, when you have a $500,000 account and you're being very disciplined on position sizing and you're only using 2, 3, 4% of the entire account, and there's $470,000 sitting there doing nothing, all of a sudden, now you've got to really think about, okay, how do I maximize my earnings on my wealth? We've talked about net worth a lot here. I personally think the optimal Forex trading account is somewhere between $100,000 and $150,000. After that, I think you want to start looking at other places to put capital because you're going to get a better bang for the buck because that cash is just sitting there not doing much. What do you think about moving excess earnings over to other accounts and other products?
For me, it would have to be excess. While I was trading, I still had businesses, but that money was allocated to those businesses. And I needed it there for, a rainy day or in case things were unprofitable. So I always separated the two. So I can't speak from experience too much there, up until, maybe like right around when the YouTube channel started, the businesses started doing better. Things all kind of got good at the same time for me. And that's when I had to decide, okay, do I also want to start adding more to personal trading? Do I even need to do that? It's all, Rob, it's so individual, man. I can't really say.
Patrick, what you just said is literally perfect. You said, I had to sit down and decide where that capital should go. I decided that this capital needed to stay here because it needed to be for a rainy day. That's exactly the point of this. Plan it all out. Plan everything out. Plan out what is quote unquote profitable to you. What is going to be the action you're going to take upon meeting those metrics? At a certain point, what is going to be the maximum value of your Forex trading account? After that, where is that money going to go? Is it going to go to real estate? One of my favorite things to do is to take my accounts down in value. I love when I have a good run and I take my accounts down in value and I go buy some real estate, or I go buy, 10 gold coins or whatever it is. I get to go do that and reinvest it in other places. The point is, it all has a plan, and that is really the point of this whole episode, is to plan out when you're going to risk more money.
No, I think that's a perfect way to wrap it up, because you guys might have noticed that this episode is a bit vague. Well, because it has to be a bit vague, because everybody's situation is completely different. So what we try to do here is kind of outline a lot of those different situations and what they might be. And the main objective here is exactly what Rob said. Regardless of what it is, just make sure you have a plan for it, and you plan for this in advance, because once it gets there, if you don't have a plan, it's going to hit completely different. And you might make emotional decisions that could end up having a really negative impact on either your trading or your life down the line, because you allocated too much or too little, whatever the case is. While you're of clear head, sound mind, and body right now, it's like I always say, plan to fail, but also plan to succeed. Most people don't do either one, but if they do one of the two, they always plan for failure. What's going to happen if I lose everything? Okay, I do X, Y, and Z. Okay, what's going to happen if you succeed beyond your wildest dreams? What happens if you succeed to where you think you're going to succeed? Then what are you going to do? Most people don't do that, and then they're so caught off guard by the time they get there, they don't know what to do. So yes, figure this part out now. And then when you get there, like I always say with your investments, like if you're going to buy at a certain point, put it down on a spreadsheet, and once it gets there, you're not going to want to, but execute that plan. This is really important, and it's so slept on because nobody thinks this far ahead, but you're going to get there at some point, hopefully. And if you do, you can easily undo 3 years of hard work and success by simply not having a plan for the next 3 to 4 years. And this is exactly what this episode's all about.
Couldn't have said better myself.
And so on that note, thank you everybody for joining us here at episode 19 of the Trading Psychology Podcast. We will see you all next week.
Goodbye, everybody.